Hey guys, it's Gary back with a quick legal tip. We're going to talk about mortgage assumptions. I have been practicing law for 28 years now, done 30,000 plus closings, and in that time frame, I've done that many assumptions, a big fat zero. And the reason that is in 1995, when I became a lawyer, interest rates were in the nines, and then they dropped to the eights and the sevens and the six, and they got all the way down into the threes and twos. So the mortgage rates really never went up to where somebody who was selling a house had a mortgage rate that was better than the going rate at that time. And so there's really never been a reason to do an assumption for the last 28 years. But now, as y'all know, interest rates today are greatly higher than they were pre-pandemic. In some cases, significantly higher. We had rates during the pandemic that were in the threes, and people now are buying houses in the sevens, and even unfortunately, we're starting to see a few eights. But now might be the time to start thinking about those assumptions. So where are all the assumptions? I haven't seen them, but we did have one in the office this week. I want to explain it to you because I do think it kind of demonstrates where some assumptions can work. It's a VA loan. The person was assuming a VA loan. They were a veteran themselves, so they were looking at getting a VA loan. Let's say the house was 300 grand. The seller had a loan they were going to pay off at 260, and the rate on that was like 2.75%. The veteran buying the house was looking at a loan in the sevens. So being able to buy a house with a 2.75 rate was a lot better than going out and getting his own loan at 7. So what he did is he bought the house at 300, assumed the $260,000 mortgage, and paid the $40,000 in cash. So he put a $40,000 down payment in the house, which on a $300,000 house was about 15% or somewhere around there. So it wasn't a tremendous amount of cash, but that does prohibit some people from being able to do it. A lot of people don't have the cash to drop on the house, but in this situation he did. So now he owns a $300,000 house. He's put $40,000 down in equity, and his mortgage payment is at 2.75%. To me, that's a lot smarter deal than if he'd have bought the house at 300, put down 20 at 280, and then borrowed at 7.5%. So there are those situations now where it does make a lot of financial sense to do it. So you need to check the numbers, see how those numbers work, talk with your veteran clients and see if they want to put some money in the deal, because getting a loan at 260 at 2.75 is a whole lot better than borrowing 280 at close to 8%. So check out those assumptions, see if they're starting to make sense, and get with a good local lender who can help y'all work through those numbers. All right, y'all have a great weekend, and we'll talk to you soon.